Good evening, everyone. Good evening. Welcome to this evening's presentation. Welcome. And I will be your presenter. Okay, thank you very much for letting me know that. The webinar is just starting now. I had a very odd spike just as I was about to click start the webinar, and it told me that suddenly the audio was disconnected. So can I just do a quick check? Can you all hear me? Just making sure that you can. Actually, there we go. Okay, cool. Okay, fantastic. All right, thank you. That's great. Now, ladies and gents, obviously, before we kick off, welcome to this evening's presentation. So my name is Adam Harris, and I am presenting to you this evening from London in the United Kingdom. And the topic we're going to be discussing this evening is going to be how to master chart analysis and candlesticks basics. So hopefully I would like this to be as interactive as possible. So please feel free to ask questions as we go, and I will attempt to answer them on the fly and hopefully to your satisfaction. So the first thing I need to do is there's a couple of disclaimers. I need to give you the opportunity to view, and while you're reading that, I will tell you a little bit about myself. I'm a fund trader. So I'm trading funds in the UK. I'm a trend trader, which means that I only trade trending markets. And I'm also a swing trader, which means that I predominantly focus on trading the daily time frame. On occasions, I can trade the lower time frames. I may look for entries on the 4-hourly chart and occasionally on the weekly time frame. So basically, I trade predominantly strong trends on multiple time frames across all different markets. I'm a big fan of trading commodities as well as currencies as well as indices. So, and then just finally, this risk warning here for trade with precision as well. So that tells you a little bit about myself. Although I can trade the lower time frames, I find that in terms of lifestyle, after all these years, I prefer to just keep my trading down to about half an hour to an hour a day, looking at the daily charts, which gives me some good opportunities. So if we do get enough time on the charts, I will take you through some of the markets that I'm having, that I'm stalking, where I'm looking for entries or where I'm potentially in trades, to give you a sense of how we apply that. I think that's enough time on the disclaimers. So on the agenda for this evening, we're going to be having a look at the technical trading secrets of chart analysis. Also included in that will be trend and price analysis, as well as reading the basic signs of candlesticks. All right, I can simplify it. Trading does not have to be complicated. The secrets to trading successfully in many ways is about doing the simple things very well. It really is about doing the basic things properly rather than the solution being in more complex techniques and ideas. Then we'll have a look at how to turn these signals into potential trading opportunities, as well as a real-time analysis of the current popular market price action and any potential opportunities that may currently be setting up. And then we'll also have a look at why to choose ATFX. All right, so again, that topic being on how to master chart analysis and candlestick basics. And then we'll come back to these slides at the end of the webinar. So what I'm going to do here is just go across to the platform, and then we can have a look at the markets quickly. Now, all right, I'm just going to do a quick check. I've got one individual saying that they aren't able to hear me. Most of you can hear me, so I'm just going to check, just message them quickly. Everybody else. Okay, good. Everyone else can hear me. Okay, good. Okay. All right, cool. Brilliant. Okay, so can I do a quick survey just out of interest for me? Can I get a sense of how many of you are within your first 3 to 6 months of learning how to trade? I'm just curious because ideally you want to get hold of people early on in their trading careers to help prevent them from maybe making mistakes, but we'll have a look at that. And so I just want to kind of get a sense of where you are. And then for me, ideally, what I would like for you to have at the end of this 60 minutes is a clearer sense of actually what technical trading is about, and certainly things to avoid doing. Okay, so trading, let me tell you a few things now, is trading should be sensible, right? It should feel like it's a good decision. This isn't about some sort of secret skill. I'll show you and demonstrate how we go about doing this, and it should feel that trading should feel like a rational, logical, sensible process, and then we'll take that into a little bit more detail. I'm just looking at your comments, reading those. So there's a question here saying, so let's go with them in order. Okay, 6 to 12 months, early trader, that's good, that's fine. Then there's a question saying, why use MT4 and not a more intuitive and illustrative platform? Really, that is actually just ATFX's choice. I understand what you mean, and actually any platform should work, should ultimately work. Listen, I mean, I would suggest, then this will be my personal opinion and not necessarily that of Trade with Precision's or ATFX's. I like MT4 because I can also use algorithms, and not that everyone has to, but I like doing that, and it's very simple and straightforward. It's very robust, and for beginner traders, there's only a few buttons to click and they can be up and running. But also for ATFX, for the brokerage, it allows them to give them time to develop a platform if they want. Otherwise, at the same time, the second they're up and running, they can offer a platform to clients. So there are various reasons to doing it. It is the most universally used platform, I understand. And I use, personally, I use other platforms in addition, but almost 95% of my actual trading is done on the MT4 platform. Just saying, it's an interesting question. Now, okay, good. So there's a couple of comments here as well. What I would like to do is also mention ways in which I manage to find consistency in my trading. And yes, so there we go. All right, so there are obviously TradingView, there's other platforms, but MT4 there's actually nothing wrong with it in terms of just a simple, intuitive, or at least a simple to use, easy to get started platform. It's very robust, and the thing is that ultimately, once you know how to use it, you can use it anywhere. So just moving on, what I'm going to do here is we're going to start off, because the theme of this is really about understanding the concept of chart analysis, as well as including candlesticks into this, really just understanding the appropriate use of that. I'm going to start really with a clean chart. And so the idea of a clean chart, and how do we actually go about doing this? So the first thing that I'm going to do is let's just go and I'm going to pick a currency first. I'm going to just set this up as a default thing. I'm going to go to the daily chart, not because it's special, but because it'll help the starting process. And then I think I'm going to have a look at creating, what I'm going to do is show you how traders build from the ground up. They start with a very, very simple chart. This is a pretty straightforward chart. I had a template saved. I just wanted it with these tools. I'm going to get rid of these indicators for now and just start with that. Right, and so we've got a relatively simple chart. And what I want to do here is start by looking at price action. So in fact, if I go even further and just delete the moving averages for now, there's no way to really kind of hide them. I can always bring them back up. Let's just remove that for the moment and start looking at price. So this is a daily time frame. This is a daily chart. And really what traders are looking to do is to find the right conditions. So the first really big step that successful traders take, or at least experienced traders take, is they choose the conditions they're going to be trading in. All right. Okay, very good question. Price action, when I say price action, again, if I use a word you're not familiar with, just ask. There's absolutely no bad questions. Please ask. I want to know. Price action is when I refer to the candlesticks on the chart, or the bars on the candle on the chart, and basically the way they're behaving. Okay, so if I talk about price action here, it means that the price action is very choppy or volatile. If I talk about it here, I might say that the price action is very smooth. So that's really what I'm referring to here. So very, very importantly, that the traders experience, and actually beginner traders can do exactly the same thing. Beginner traders can choose the conditions they want to trade. This is very important. It's much smarter for a trader to say, I want to trade. The reason I like trading trends is because the market has a very clear direction where it wants to go. So if I get in that direction, the probabilities of price continuing in that direction are greater than just suddenly changing direction. If I get into a chart that has no clear direction, then I can't be surprised if the market keeps changing direction, going up and down. So let me just show you here. So if you look at this patch, let's call that patch over there. Okay, so I'm going to go in and just have a look at that. During this period, if I just got into the market here, there is no clear trend at this point. This is incredibly dangerous to trade when the conditions are like this, because the market's going up and down, the bulls and the bears are fighting it out. Okay. And all right, so there's another question saying, what are the characteristics of a successful trader? What are the mistakes that traders should avoid? I am actually going to talk through those. That's, in a way, is what I'm actually doing right now. So whether you refer to this as a range or consolidation, the point is that the conditions during this period are not safe to trade. And again, many traders make the mistake. So again, you're asking the question, of what do professional traders avoid doing? What are the mistakes they avoid doing? What are the things that they do? The first thing they do is they choose the conditions they're going to trade in. If the conditions are not right, they will not trade. Okay, so if the conditions are too choppy, they will stay away from them. If I look at the chart now, it's moving. There's some strong trends on the 4-hourly time frame. That will come with experience, that you know that. But if the conditions were like this, no trader would approach this. Now, the other thing is that traders do not trade one particular instrument. Okay, they don't do that out of loyalty. You don't have traders going, oh, I only trade the euro dollar. That is silly. It doesn't make sense to do that. All right, and they don't just trade. They might prefer to trade certain markets. You might get a trader that says, I prefer trading currencies, or I prefer trading equities, all right, or stocks. That's possible, but they won't just trade one instrument. Or if they do, it's just, that's not really, in my experience, where the best traders come from. The best trader is not concerned with what it is they're trading. They're much more concerned with what the conditions are of the element they're trading. So, for example, right now, if we go and have a look at this on a weekly basis, you will see that price is pretty much on this chart, pretty much bouncing between a couple of key levels. Okay, generally speaking, it's kind of stuck between right now within this overall range. All right, and so that means that there's no longer term trend as well, shorter term moves here. But if you see, if we go down to that 4 hour, just let this refresh, you can see that there's very much a strong trend. So there may be some day traders. Okay, so swing traders, the expression is swing traders, will trade the daily time frame and higher, and day traders will trade during the day. All right, so they'll trade lower time frames. So day traders would potentially be trading this on the lower time frames, but there isn't really an opportunity so much on the daily, and certainly nothing on the weekly. So there's nothing here for swing traders. There's nothing really here for, there's only a few opportunities for day traders. If we go down to the lower time frames, we can see that there's a very clear trend. So this is the point, is that this particular chart has no appeal really for day traders, but for traders on the lower time frames, there's a very clear trend, and therefore they will look to trade that. But again, both traders will know where these key levels are. So, which brings me to the next most important point. All right, the very, very basics that every single trader must have on their chart, or that they will look at, will be price action, which is the candles, and horizontal levels, support, resistance levels. Okay, these levels are very, very important, and these will be the minimum information that every trader needs. Traders must have support, resistance levels, must be visible to them. Okay, these levels define where price is going to. So if price breaks through this level, it's probably heading up to that level, and so that gives traders a sense of how much potential trading meat is on the bone, so to speak. So this is really what they're going to be keeping an eye on. Okay, once they break through that level, they'll probably be heading up to that level. So these levels vary depending on the instrument we're trading, and all traders need to know where these levels are so that we can take advantage of those trading opportunities. So most professional traders will identify where are the monthly, weekly, and daily support resistance levels. That's where they will focus a lot of their attention. And what they look the most for will ideally be areas where price has tested that level from both above and below. So here you can see, for example, we've tested it from underneath and from above, and also up here price is testing it from above as well. And basically we look to draw a line that connects the most dots effectively. That usually is significant to the instrument that we're looking to trade. So if you said to a trader, you're not allowed to trade with a whole lot of stuff, the very minimum a professional trader could trade with, and in fact, some of the professional traders only trade with just support and resistance levels and price. That's it. And these levels will always be significant because that's ultimately what the underlying market is made up for. And this brings me to another important point. Traders are aware that there is actually a market underneath. The market isn't just driven by the news. It isn't just driven by Brexit. It isn't just driven by what Trump says. The market underneath is made up of actual business transactions taking place. If you look at currencies, it's made up of hedge funds doing trading. It's made up of banking institutions or central banks, government central banks that are exchanging money as well. It's made up of businesses paying suppliers. It's made up of tourists exchanging money. There's a lot of things happening where large transactions are taking place, and these will potentially impact the price, the demand and the supply of various currencies, as an example. And we often forget that. People tend to think new traders are led to believe that the news is what drives the currency markets. Okay, and although it may on occasion spike the market, it doesn't necessarily set the trend, and that's a very important realization. Now, year in and year out, what causes most of the moves in the currency market? It is usually the difference in interest rates between countries. The difference between interest rate between the Japanese yen and the US dollar, or the British pound or the Australian dollar. That can often influence the flow of money. Then on a month-to-month or weekly basis, it will be transactions, and occasionally on a daily basis, it might be certain news announcements. So on the whole, we tend to follow transactions, but price levels also become quite significant. The next thing that's very, very important to keep in mind is that not that many traders are actually trading the news. It's another thing that beginner traders seem to be led to believe, is that traders are actively trading the news. There are some algorithms that trade the news, sure, and there are some traders that trade it, but that doesn't mean they're successful. Some of the best traders I've ever met absolutely completely avoid trading the news, because the news is close to gambling. We don't know how the market's going to react. We don't know what the reaction is going to be, and therefore we don't have an edge. The perfect trader, or at least the perfect results, would be a trend that will carry on as long as possible without being broken, and the news could potentially end that trend. So usually traders will be very cautious and look to trade things around news events instead of on top of news events. They'll try to avoid that because they don't want the trend to be interrupted. So starting again, just to recap, we look at price on the chart. We then start to frame it, draw lines around it on the daily, weekly, and monthly to identify these key levels that price will travel from. These key levels help us identify how much potential profit is on a trade. They also help us identify areas where we might be able to place our stop loss on the other side of these levels, sometimes for additional technical stop loss protection. And sometimes even help us get entries. If price breaks through a level of resistance and comes back to test it for support, we can occasionally find an entry and then get in on that side. I'm going to have a look at your questions now quickly. Questions are coming through thick and fast, so just trying to keep an eye on this. So the questions are as well, how can we know when to enter and when to exit? I will cover some of those concepts. I can't do an entire course within 1 hour, but I can cover concepts for you. What I would suggest you do is, if you have the ability, to let ATFX know that you'd be interested in a trading program from them, and I'm sure that we can assist with that, and we can actually handle that with you. I'd love to do that myself. I like doing that. So just look at your questions as we go. So why are candlesticks? Why are the candlesticks different lengths? Okay, the candlesticks are different lengths because the market would have moved more or less during that same period. Oh, okay, hold on a second. Let me just have a look. So One individual has just said that there isn't anything on the screen. I just want to check that that's the case. You should be able to see the chart on my screen. Just trying to have a look at some of these comments here. There we go. Do traders look or consider or identify safe currencies or go-to currencies? On that one, quickly, if we look at the majors, which is all the big currencies against the US dollar, there's 7 of those, or 8, depending on how you look at it. There's usually 7. There's dollar Swissy, dollar CAD, dollar yen. Thank you. Just checking. Thank you. So there are 1 or 2 individuals who've had some issues. That's why. Okay. Sanjeev, I'm not sure why nobody else is having that issue. I'm not sure what to say. Could you potentially try logging out and then logging back in and seeing if it improves? So safe currencies, look, safe currencies isn't really a thing, as in what I mean is right now a lot of people avoid trading the Swiss currencies because they've intervened in the past. There's no real trends on them, and so they'll avoid charts where there's not a lot of trends. And so the Japanese charts as well, the JPYs, the yens, don't trend a lot right now. Some of the charts are, but not really. So really they'll focus on the ones where the trend is, and then that would be considered safe. But there's about 27 major big currencies we can trade, which is Euro, dollar, pound, dollar, and then it goes on to Euro, Aussie, Euro, CAD, Euro, yen, and then pound, Aussie, pound, CAD, pound, yen, and then CAD, yen, Aussie, yen, Aussie, Kiwi. Basically, that amounts to about, on the left-hand side, you can see most of these currencies here, and that would amount to the 27. When Draghi talked last, euro dollar fell, but the daily uptrend ultimately prevailed. Exactly. And so that's exactly my point. Might be smaller, lower time frame reactions to the news, but on the whole, if there's a trend, it can often prevail. And how can we know when to enter and when to exit? That's fine. How do we define a successful breakthrough of the support and resistance, as some just break through the resistance line and pulls back? Again, that's a great question. I'm just aware of the time. I want to make sure that I cover the things that I'm meant to do and try to answer as many of your questions as possible, because the questions you are asking are fantastic, by the way. They are great questions, but I also want to make sure I cover everything I need to do. So there was a question saying, how do we know if there has been a successful breakthrough and retest of a support or resistance level? So what I'm going to do here is just talk about that for a second, because many people would want to know that. So first of all, let's talk about when a line gets rejected. So in this particular case, if I just zoom in, if price comes up to a known level and then you get a rejection candle and then price breaks the other side, so in other words, you get a swing high. So you need not only the reaction against that level, but you need the following candle to break in the other direction. That would be a rejection of that level. So in this case, that was a rejection of that level. Then it came up again. There was a bearish candle here. So let's take a moment here. Because of all the way the questions are being asked, we're going to cover everything, but not necessarily in a straightforward manner. I'm going to be giving you quite a bit of information. So on the topic we're going to talk about is candlesticks. And let's just discuss that for a second. All right, so again, I want to make sure I answer your questions as we go through. So candlesticks, Japanese candlesticks, really are made up of a body, which is the open and close. This is usually if price opened at the low and then closed up here at the high, that would be the open and close. That would be the body of the candle. The thin lines above and below we refer to either as wicks or shadows, and that usually represents the entire range where the market moved during that period. So this big candle, this green candle here, would have opened, would have moved around, went down to the low, then it went all the way up here, bobbed around, and then ultimately closed here. Okay, so that is the whole session during that whole day. That's all the movement that candle would have made. Now, the thing is that there's a famous author, Steve Nissen. He went to the East and the Far East, and he discovered the Japanese were using candlesticks in the 70s and 80s. And then he wrote a book, and the Japanese have, this book it's quite famous. So Steve Nissen's Candlesticks is the sort of ultimate guide to learning about candlesticks. However, if you want to read that, go for it. But the more important thing to do, just as I said, is for traders to focus on trending markets that are much simpler to trade than something very complex. And that's actually where a lot of money can be made. All the big millionaires that made their money in the 80s, 70s, 80s, and 90s trading were trading stocks, but mainly because back then currencies was a new thing, but they were trading trends. That's what they were doing, trading trends. Okay. So candlesticks can basically be, and this is the part I want you to remember, candlesticks can be split into, so I'll just create a notepad here so that you can see this, and then what I'm going to do is, excuse me, increase the size so that you can see this. And so one of the things that they will do is that candlesticks, okay, can be put into one of three categories. Okay, and this is important. So categories, not sure why I'm spelling that badly. Okay, so they are either bullish, bearish, or indecisive. That's it. Those are the one of three states that can. Bullish means they want to go up, or they're strong. Bearish would mean they're weak. Usually this means they're green. This would mean they're red. Indecisive would mean that they're not sure where they want to go. Okay, so if we talk a little bit about bullish, this would be a very nice bullish candle. This is also a bullish candle. This is also a bullish candle. These are all bullish candles. Okay, when we talk about indecisive, this is a nice indecisive candle. Generally, the wick is the same above and below. Okay, this is also indecisive. If I had to be more specific, I could say it's bearish indecisive because it's a little bit of red. This is very bearish. That's a very bearish candle. That's a bearish candle. That's a bearish candle. Okay, this one is actually bearish, although it's green. All right, it attempted to go up and was pushed all the way back down. So it failed to go up. It happened to close a little bit higher than the low, but it is actually quite a bearish candle. This is a nice bearish candle. That's a bearish candle. These are also slightly bearish. Okay, in a downtrend, you can see they've got these tails like they're falling down. That's nice and bearish. That's bearish. That's bearish. This is a nice bullish candle. And so we get, they can fit into one of three categories. Like this one here is a nice bearish candle. This is a very bullish candle, this one here. This is also a bullish candle. This is an indecisive candle. The one generally where it has a small body and generally the wick above and below are more or less the same length. So every candle can be fit into one of those three categories. What we look for, ladies and gentlemen, in an uptrend is bullish candles in an uptrend and bearish candles in a downtrend. Generally speaking, that's the starting point. That's where they should be occurring. The indecision candles here will very often occur at the turning points. A turning point at the top, we call that a swing high, and the turning point at the bottom is called a swing low. So that's also where the swing trader name comes from, trading those swings, the turning points. For me, however, I will only be trading the swing highs in the downtrend and the swing lows at the bottom. So the next thing that I want to talk about, all right, you can see we've got some strong trends here. And so we have, when the market is ranging, when it's going sideways or consolidating, it will have a lot more indecision candles in it as well because the market itself is indecisive. So generally, the makeup, the shape of the candles is pretty much contributes or makes sense within the context of the trend. So indecision candles can form a lot in the middle of a range. And bullish candles will often form in a strong trend. So there'll often be nice bullish candles in an uptrend, bearish candles in a downtrend, and usually indecision candles at the turning points, okay, those small candle bodies. So again, we have broken that. Let me go back to your questions now and carry on. So I've done that. So that's when we talk about the breakthrough of support and resistance. The next question was that if we can have price, here, for example, is a nice rejection of that level. Price comes down to a level, produces a bullish candle, and then breaks the other way. So it's the same thing if we break through a level. If we have price, here we go, break through a level, comes back down, produces a series of bullish candles, and then breaks up through that. It's when it actually breaks above the high of that collectively is called a rejection of that level there. So it isn't just one candle. It's a series of candles that basically go test the level. They've tested this level here, and then they've head away from it. And when they break the high of this candle, when it breaks the high of that has now been rejected. Okay, and so a breakthrough and a retest and continuation would be successful at this point when price breaks above the high. Hopefully that answers your question. So The next question is just place monthly, weekly, daily support resistance levels, decide correctly whether to place a trade or not. That's the starting point. And the question as well is which concepts are we covering in this session? The only concepts that we've really initially planned to cover in this session is understanding, talking a little bit about how traders start with a blank chart and build up from there, talking about candlesticks as well. And so that's what I'm doing as we cover those. Okay. How to trade in a ranging trend. Okay, so how to trade in a ranging trend we would do, okay, as we go through. Generally speaking, that would be a last resort. We would not really want to do that, but if we look at where price is at the moment, if we go and have a look at this on a monthly time frame, we are actually, let's go, sorry, to a weekly time frame. Let's go back to this. We're still within this range. Why do I say that? Because if I just draw this on, we're still pretty much stuck within that whole price range. Okay. So if a trader was going to trade from when price gets rejected at the top and heads down to the bottom, they would usually go down to the lower time frame. So this is a weekly. They would go down to the 4-hourly and potentially trade it on the way up. But I must stress, for me, this is not the best trading opportunity in the markets right now. And I will get to that in a moment. I will cover as much of that as possible. So where's the best place to, the next question is, where's the best place to place support and resistance lines? The tip of the wick or where the candle closed. Now, this is an interesting discussion only because so many people ask that question. It's a very commonly asked question. The correct way to draw these levels is to connect as many dots as possible. So in this particular case, I'm looking to connect with the tops of these wicks, as well as the bottom of these ones, as well as the bottom of these ones, as well as the tops of these ones. So I'm looking to basically connect as many places as possible. In this case, I draw this here because it connects with all three of these, but you will also notice in that particular case that here, sorry, I'm just trying to get this away. How does that happen? This will connect with both the wick of this candle and the body of this candle, the wick of this candle and the bodies of these. Okay, so it's more important to connect as many dots as possible than it is to pick the body over the wick, for example. Now, okay, you are able to view them. Good, good, good. Okay, what are the important candlesticks to get spotted in the chart? We'll cover that in a moment. Is the candle a figure, 1 or ranging from -1 to 1? I need to consider that question because offhand it's a new one for me. Which time frame do we see to trade? Understand a higher time frame gives accurate sentiments. Yes. So this is again, another important point is beginner traders are often, and by the way, I'm not criticizing at all. I'm saying I was a beginner trader and I remember very clearly what it was like to be that. We all have very much the same experiences. So in the beginning, we often think that the lower time frames, the 5 minutes or the 15 minutes or 1 hour, is the key to understanding where the market is going. But actually, the most important time frames are the monthly, the daily, the monthly, and the weekly. They very often tell us where the market is ultimately going to go. That is the prevailing trend, and we can take shorter term opportunities on the daily and the 4-hourly and the 1-hourly and so on. Okay, so what I've done here is, first of all, I've spoken about identifying these key horizontal levels, also having a look at price action. Usually I like to look at the last, so what I'm going to do here is get rid of some of these objects quickly. So let's get rid of these 2 rectangles. Okay. All right, so usually once I've identified these important levels, let's put them in. I never used to use pink, but I like the color pink because it stands out. If you look here on the daily, there's some good levels here. So that's a nice level there. There's also another daily level just below that, which is down here. Okay, so there's a couple here. So there's also, if I look again, this is on the daily time frame. There's also clearly some more over here as well. There's a bit more there. Lots and lots of touches at those points. So shorter term opportunities arise over here. I start with price action. I then frame price action around where it is. I don't need this level up here because why? Because price is nowhere near that. I can keep my chart nice and clean. And then what I can also do to help myself is to add in moving averages. So this is where it gets really kind of cool. I can then insert moving averages. So what I'm going to do is very quickly is just reload the template, go back to the moving average. So what I have done here, which everyone is going to ask me now, but I'm just going to answer this properly, is talk about what's on the chart at this point in time. So I have added in 3 moving averages. The simple, it's a 50 simple moving average, 50 simple, and I've made it red because the colors are traditional. You can change the colors, do whatever you want, but it's much easier to use the traditional colors. So I have got a 20 and I have got a 10. Okay, so this is the 10 moving average when it wants to show me the 10 moving average. And so this I can use to frame price action. So if I go down to the 4-hourly time frame, look how nice this is. This area, the area between the 10 and 20 moving averages, this is my personal way of approaching trading. Let me just take a sip of water quickly. My personal approach to trading is usually to look for entry opportunities from within the area in the 10 and 20 moving averages. When there is a very, very nice trend, it will often interact very well with these 2 moving averages. So in other words, I could treat the area between the moving averages as a potential entry point to get into the trend. And so what I will often look for is a nice bullish signal in an uptrend. So this is a nice uptrend. And so I will be looking for, and this is just an introduction to, please understand, this is just an introduction into this. So what I'm going to do here is just mark a few items here. For example, for me, a nice little bullish candle looking into this. There's a nice little bullish entry signal into a short-term trade. Now, very important, ladies and gentlemen, you've obviously heard, or you should have heard by now, that we always trade with a stop loss. Okay, we always do this because trading is about looking for lots of setups that all have a very high probability of success, but we also know that not every trade is going to be a winning trade. So out of every 10 trades we take, some of them might make 1%, some maybe make 3%, other trades will be losing trades. So the goal is, out of every 10 trades, we are still up maybe 2 or 3%. If we can do that out of every 10 trades, we're doing fine. The whole goal with trading is to do this consistently so that for every 10 trades we take, we are net profitable on percentage. So the other mistakes that beginner traders make, and again, these are all things that I'm telling you that traders do and don't do. Traders look, with currencies, for example, it makes a lot of sense to look for a 1-to-1 reward to risk. So what does that mean? That means that traders will look to make at least 1% return for their 1% risk. You may not have heard this before, but many traders prefer to risk no more than 1% per trade they take. So in this case, if I was looking to get in above the high of this candle with my stop loss below the low of it, because I think price is going to go up from here, one of the things I would look to do is that would be my 1% risk, and that same distance would be 1% reward. So in currencies, many traders take at least half of their profit off the table when they hit 1-to-1 target. That's called our 1-to-1 target. Sometimes, of course, the market can carry on and we can get a bit more profit. But please understand the difference between gambling and trading. Gambling is hoping, and there's no real evidence, there's no real reason to believe the market will go where it will go. It's like playing the lottery. Whereas trading, we know that in a strong trend, the market is likely to continue, but we have no guarantees it'll go forever, so we take profit. Beginner traders often make the mistake of trading without a stop loss, risking more than 1%, and most importantly, not taking profit. Okay, they're up 3 or 4% on a trade and they don't take profit. Then the trade comes back and they give back the profit. Professional traders will always have a stop loss. They will always take some profit as they go, and usually they're getting ready to exit. Most professional traders are happy with 2-to-1 or 3-to-1 reward to risk trades, meaning that the distance the market moves is 2 or 3 times the distance from the entry to their stop loss. I want you to hear that and remember that. Professional traders do not expect the markets to carry on forever. They will happily get in again and again and again, but they'll always take and exit their trades at a particular point. Okay, so for me, for example, if I was looking to get into the market and I happen to get in here, as I said, this is not the one I'd be trading, but if I got in, there's a nice little bullish candle in that area. Once I've gone about this far, that's probably a 1-to-1 or 2-to-1. And for me personally, I often take 3-to-1 and I'm out. In other words, once I've hit 3 times my distance, I close out the trade. So that means I might have missed out on all of this. Fine, absolutely. But it also means that here I would have made some money, potentially here I would have made some money, here I would have made some money. Okay, even here I might have made some money. Not every trade is a winner, but it also means it's very important that we understand it's like going fishing. We go to a place, some days we get no fish, some days we catch a fish and the fish goes back in the water. Other days we catch a shoe that someone threw away. Other days we get a big fish. Some days we get lots of small fish, but that's the point. Okay. So we look to take profit. Professional traders must take money off the table. And so what they would do is look for conditions where there's a strong trend, look for an area where they would get into those trends, and then look for entry signals, which might be a particular candle, which is bullish in an uptrend or bearish in a downtrend. So let's go look at some of the other markets. Let me have a look at your questions quickly. So the question is, do the moving averages follow different trend lines? We're not really using trend lines here. In a way, the moving averages become organic trend lines. We can see they follow price and price follows them. Okay, now we're not also, here's the thing, we're not, very important, we're not looking at the moving averages first. We're looking at price first. The price is trending, and we are just using the moving averages to look for entries. We are not waiting for the moving averages to cross over. So just saying that we don't stress about that too much. Okay, how are we able to read the instinct how the big boys enter? Most of the cases, traders against professional traders. That's not true. I've heard that. I've heard people say that. Please understand, ladies and gentlemen, when we trade with the trend, we are trading with the big boys. That's very important to understand. It's in many ways is a myth that traders are trading against us and they can see our trades. Nobody can see our trades, all right? They can't see that except within ATFX. Okay, so only ATFX can see ATFX and only the broker can see us. There's no one else who can see our trades. And if we trade with the trend, we are trading in the shadow of the big traders. Okay, so it's just a myth often when people are trying to sell the market share and the market's going up, they say that the traders were pushing it up against us. It's not the case. That's just a myth. We are looking to see where the market is going. We are like the little fish that piggyback on the sharks. Those are called remora fish. We are basically going to take the scraps off the big move. So very important that when we follow the trend, we are trading in line with the bigger traders. That's very important to understand. Okay, we're not fighting them. We're actually going with them. And by the way, interestingly enough, there's a lot of traders. I mean, I know today a lot of the big banks, JP Morgan, all these very big banks, they haven't been making money in the equity markets. And the reason is the equity markets have been moving, but they are a bit too scared. They're so big and they don't want to lose money. They don't make decisions. So the hedge funds have been making all the money because the hedge funds can see the markets going up and they have they're technical traders like me, so they're buying. Okay, and they're not in forever. They get in, they take money, they get out. They get another entry, they get in, they take money, they get out. And the market keeps moving. It's common sense. There's no voodoo, there's no smoke and mirrors here. We can see the market is trending. We should be looking to buy. Okay, or if the market's going down, we'll be looking to sell. Look at gold. So let me take you through to gold. See, gold now is in a downtrend. So now I should be looking to sell. Now we're coming back into the moving averages. Price is coming back. So I can wait if I want to. I can now potentially wait for an opportunity for price to come back in here and then look to sell. So I will look maybe for a nice bearish candle when price gets back in here, and then I'll look to go down and sell. And I will take 1% or 2%, not ridiculous amounts. So it's very important that you understand it's common sense. I'm trading because gold is going down. I'm selling gold. I'm not reading the newspaper. I'm not trying to guess why gold is going down. It doesn't matter. If gold goes whatever I'm going to be trading in 6 months' time, it's because it will be moving. It'll be moving up or down. I do not need to know why. I just need to trade it because it's trending. All right, that's very important. So the next clue or the next important thing I want you to keep in mind is what traders are avoiding. So this is a nice trade. This is on my personal watch list. Okay, tomorrow I might take a position on this. But what am I avoiding? I'm avoiding markets that are going nowhere. I will stay away from markets that have no trend. Let's have a look and see which markets are going nowhere. This market, to me, if I had to choose, if you had to choose between these conditions and these conditions. Which one has a clearer trend, gold or the euro dollar? Which one has got a clearer trend? Therefore, ladies and gentlemen, which one is more likely to go in a direction? Okay, I want you to think about that. I can choose between the two. I have a choice. I can trade something with a very strong trend, or I can trade something where the trend isn't that clear. Okay, this market's also bearish, but I can't trade everything, so I will pick the best. What else? There we go. Look at this one. No clear direction. Okay, no clear direction. The market is going sideways. So this is terrible. Kiwi dollar. Terrible, 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 terrible. Look at that. Up and down, up and down, up and down. It's a bird's nest. This is just a car accident. This is horrible. Okay, so if I have to pick, what am I going to pick? I want something with a strong trend. So let's go through a few more charts until I see something with a strong trend. Euro Aussie, it's okay. It's not great. What else? Euro CAD. Nah. Gold was still the best one so far. That's good. Euro Swissy's got an uptrend. Not bad. You can see it's got a clear trend. What else? Euro GBP. Yeah, a bit of an uptrend. It's okay. So far tonight, the best ones we've seen. Gold, Euro Swissy. Let's have a look at some others. So this one had a trend. The trend is now finished. So it's gone. Markets will go from trending to not trending. This is terrible. Horrible conditions. No money to be made there. There's no professionals trading this. No professionals trading that because there's no clear trend. Let's go down here. Pound CAD. None of these look great. Pound Swissy. Just looking at them. So not every chart is necessarily tradable. That's up. This is okay. That's actually not bad. So this is pound yen, potentially trading to the downside. Let's look at pound Kiwi. Not, oops. Okay, no, that's not so good. Let's look at Aussie CAD. Nope. Let's look at a few different markets here. That's interesting. So here you can see it's largely going sideways. Let me get rid of some of these objects quickly. So I'm just going to get rid of that. Actually get rid of all of them. That's not bad. It's not great, but it's not bad either. Let's look at Aussie yen. Okay, it's not great. So let's have a look at what are the other markets we've got here. Dollar Sing. Let's see what that looks like. Okay, it's okay. It's not great, but these are really the ones we'll focus on. What does the Hang Seng look like? These are indices as well. Okay, not great. What does oil look like? Let's see oil. Oil's been moving quite a bit. Let's see that on the 4 hour, on the daily. Look at that. How beautiful is that trend? There we go. There's our entry signal. This is one I'm in. Sorry, I meant to tell you this is in. There we go. I'm not in everything. I'm looking to short gold tomorrow. I'm in oil today, and I am worried about this level. So before you think I know for sure, I don't. There is a bit of a level there, and I might just make a bit. It might fail to get through there, but I think it'll be okay. Okay, and so point is, you can see there's a clear trend. Okay. So there's another question here is, how about the moving average for 200 days? Can we use the spot for entry? You'll see that the 200 I like to use on the lower time frames for confirmation of the trend, but I'm actually using price action to tell me when that breathing out, breathing in, breathing out, breathing in. I'm looking for these particular candles, and those are my entry points. And I look for them. Think of it like a train. Okay, the 10 and 20 moving averages is like the station, and the train leaves the station, comes back to the station, leaves the station, comes back to the station. And I look for these nice bullish candles in an uptrend or bearish candles in a downtrend. Okay, and I'm trading price action as it's happening. So other questions. When do you enter here in the case of a 10, 20, 50 simple moving average? I really do not know about hedge fund trading techniques, and I think hedge fund trading is another topic altogether. Yeah, technical analysis trumps the news. In all the years I've been around, technical trading is way better than fundamental analysis. Fundamental analysis is where I think that works very well is with stocks. If I can look at the numbers for a company and I can see all the numbers, I can determine if it's overvalued or undervalued, but I can still use technical analysis to find entries. But when it comes to everything else, technical analysis allows me to trade any market. I can look at it. If it's trending, I can trade it. So when placing a trade, is it better to place 3 trades at 1% each with the same stop loss but differing take profit, or a single 3% trade? That is a brilliant question. What I do, again, these are my opinions. This is not financial advice. I can tell you what I do and how it works for me. What I do is I actually split my 1% into smaller percentages. So I do 2 trades. So in other words, I will look, if I'm looking at this one, I have 2 orders, 0.5% each. Okay, they both have the same entry and they both have the same stop loss. But one of the trades will have a 1% target. In other words, sorry, a 1-to-1 target. When it hits that target, which is about here, it will close the one trade out. So I will make 0.5% on that trade. Then with the other one, I will trail my stop and I usually have a 3-to-1 target. So it's a great question. I split my 1% down into multiple orders rather than having 3% exposed. Gold has got a better trend. Euro dollar, yeah. So I preferred gold to the euro dollar. I need to wrap up, so I'm going to recap what we've covered, because believe it or not, we've actually covered even more than we were supposed to. So euro dollar was this time frame, and that was what the market was looking like on the 1 hour if I just zoom out. And then gold had this trend. So gold has a clearer trend. It's much more bearish. It's moving faster. It has momentum. That's what we talk about. It has momentum. Let me finish up these questions because I have to wrap up the presentation. Is it possible to set alarms when price hits a certain level? I cannot look at all charts at all times. Unfortunately, you know what? I bet you there is a way to set it to do that, okay? To set alerts out. I believe the answer is yes. Drawing trend lines does help. Obviously, why do I like the 10 simple moving average? Because every really nice stable trend will interact with the 10 and 20 moving averages. So basically, if it's a really solid trend, it will always interact with those moving averages. So it's just an area where I can look to get in. Let's keep reading these questions. So it's nothing complicated. You can use the 200, 50, 20, and 10. It's a starting bar. Can I explain something on a pin bar or reversal pattern? This is being recorded. I will upload it. I believe you will get access to this recording. So what I'm going to do now, ladies and gentlemen, is let's just go back to the slides. Let's go up here and just cover those agenda slides. We spoke about technical trading secrets of chart analysis, which was putting the candlesticks on the chart, putting in the horizontal levels where price connected it from both sides. We spoke about looking at what does a trend look like versus no trend. And then we spoke about price analysis. Okay. Then we spoke about the basic signs of candlesticks, but it's very important. It's so, if I was training, teaching my son or my daughter to do it, I would say candlestick is either bullish, bearish, or indecisive. We don't have to be too complicated. All right, and so we looked at that, the body versus the wick, and we look for their reactions on the charts. Then how do we turn these signals into potential trading opportunities? So we spoke about the moving averages on the chart, how we get bullish candles in an uptrend in the 10 and 20 moving averages, and bearish candles in a downtrend. So let's go back to the charts, have a look at gold's bearish candles. So here on the lower time frames, bearish candlesticks for me in the downtrend here are these nice little rejection candles over there. There's a strong, nice little bearish candle there. Bearish candles here, bearish candle there, bearish. These are, the way I like to think of them, these are sellers entering the market. Okay, so when it turns red. So generally looking for bearish candles in an uptrend. And if we look, bearish candles in a downtrend, bullish candles in an uptrend. So if you look at, you'll see bullish candles in these areas as we hit up. Nice little wick in that. These are also finding some strong setups here. And then we had a real-time analysis of the current popular market price action. So I know that some of the markets I've shown you through, we could see that quite a few currency markets did not have great price action, but a few did. We've got oil on the daily, looks great. We've got euro dollar within that range on the lower time frames. We saw gold has got a good downtrend happening on the lower time frames as well. And so the goal would be to run through the, say, 1 hour and 4 hour timeframes and have a look at that. And so these are where I'm focused at the moment. There's not a lot of currency trades other than, for example, those shorter term trades. So just as it happens today. So if we did this exact same webinar a month from now, there could be all the Aussie charts, Australian dollar charts could be moving. Okay, so let's go back to this and just quickly wrap this up, and I'll look at your questions. So ATFX are obviously regulated by the FCA, the Financial Conduct Authority, and it's an efficient, secure, easy to use payment portal. They're committed to providing competitive prices for the clients, their clients, not our clients, their clients. And Global Investors, obviously most widely used platform, which is MT4, as you know, bespoke customer service. So any assistance or support that you need, you can get access to. These are the contact details as well. So should you have any questions, you can get hold of them. Again, as I said, I would mention, if you get the opportunity, if there's a short survey afterwards, to mention the desire for a program where, for example, we could do a program where we take you through 2 strategies with risk management and psychology. So everything basically that you need to know, at least to get you started. And risk management is a very important aspect of that. Plus we do market analysis. So these are just suggestions you could ask about if you wanted to, but I'm only suggesting that because we could do it, but the client needs to make the decision if they want to do that. These are the contact details, and basically, I'll have a look at your questions. I want to say thank you for your time. I know it was 1 hour. It's very, very short, and we had to cover a lot in it. I mean, I could talk forever. So, but yeah, I wanted to say thank you for that. Let's just have a look at any of the last questions. The question of how do we correlate between a larger time frame and a smaller time frame is actually a really good and very important question. I'm just a little concerned we're a bit low in time. One of the suggestions is, very quickly, I want to do that because for everyone this is a worthwhile question to ask. So the question is, how do we correlate between a lower time frame and a higher time frame? So for example, here we're looking at gold. It's in a downtrend of lower highs, lower lows on this time frame, and you can also see some very important levels that there are. You can see we've broken through that level now, and overall, you know, it's moving down a little bit low. If we go down to the 1 hour, we can see that trending. So generally what traders are looking to do is to make sure, ideally, that they're trading in the same direction as the daily. So if the daily is trending down, they would be looking to go in the same direction. If the market has no clear direction at all, like Kiwi dollar, then they would not trade it at all. And if, let's say with oil, it had a nice strong uptrend, they'd ideally be looking to trade it to the upside. Okay, so that's a 5-minute time frame trading up because the daily is trending up. So the daily is the starting point for most professional traders. Next question. There's a question of how simple is it to transfer from an existing partner to ATFX. I would recommend you get in touch with the lovely folks at ATFX and ask them how to do that. That's not my area of expertise. And so again, there we go, ladies and gents. I want to say thank you. I'm not desperate to get rid of you. Relax. I'm enjoying my time. I just don't want to keep anyone past the evening. Plus, I suppose I do have to eat supper, and it is 9 o'clock. So as I said, yeah, I'll be having a look at gold tomorrow, maybe the euro dollar, possibly. I will be avoiding trading around the news. I will be looking for clear trends. That's what I want you to get a sense of tonight. The traders aren't randomly trading charts. They're picking conditions that have very clear direction. And when they're trading that way, they're trading in the same direction as all the big institutions. And remember that the big institutions also have to trade against other big institutions. So they can also have their struggles. What we do is we don't concern ourselves with that. We look at which markets are moving no matter what they are, and then we focus on going in the same direction as those trends and taking profit, not just expecting it to run forever, because that's foolish. We look to take some profit off the table. We look for good entries. We look for good exits. And as I said, there's that train leaving the station. Price comes back to the moving averages, heads out. We take some profit. I take some profit, comes back. I look to get in and out again. So I do hope that you've enjoyed this. Again, I'm Adam at tradewithprecision.com. And so I hope you've enjoyed yourself. Thank you very much. If you do a survey and you get asked to do a survey and you enjoyed this, let ATFX know, because yeah, their heart's in the right place and they want to make sure that you get what you need. So thank you very much, and I look forward to seeing all of you in future webinars. And I really appreciate all the questions you had. I'm sorry if I didn't get to all of them. I tried, but I loved all the questions. So thank you very much. What I'm going to do now is I'm going to end the webinar. It's going to hoof us all out. It is recorded. It should be uploaded. And I believe that you may get a copy of it or a link to it in the email afterwards. So thank you again.